Hello and welcome to my channel. Today we are going to look at, is it time to get back into some of the big oil stocks? So we know in 2020 there was a huge demand shock. The demand for oil collapsed because of COVID and all the restrictions in the economy, airlines, and so on. So when that happens, when we get a demand shock, there are three things that will typically happen. And I want to go over those three things. And those three things take time, and that time has evolved. And now it's time to start looking at whether to buy oil stocks or not. So let's take a look at the price of oil in 2020. There's a chart of oil over the last few years, and prior to COVID, oil peaked above $75 a barrel and traded slightly below that, $45 to $65 a barrel. Then when COVID hit and demand stopped for oil, demand fell off a cliff. There was a huge demand shock. Nobody wanted to buy oil anymore, and the price went negative. Fell to minus $37 a barrel, and that meant that producers were now paying buyers of oil to take their oil, and this was unprecedented. This has never happened before. It was a huge demand shock to the point where nobody wanted oil anymore. All the storage capacity was full, and now producers were paying buyers of oil to take their oil. Now when this happens, we have a demand shock in the oil industry. This would have been a good opportunity for the U.S. government to step in and take all they could while producers were paying for it. So why producers were paying minus $37 a barrel for it, the U.S. government could have taken all they could and stored it in the Strategic Petroleum Reserves, which was created in the 70s for emergencies. And they could have stored it there for a few years and turned around and sold it a few years later at above $60 a barrel probably, and made billions of dollars on U.S. taxpayer money. And that doesn't happen very often. It's only happened one other time that I know of, and that was the 2008 financial bailout when the government bailed out the big banks. They were the largest buyers of their shares at the very bottom. A few years later, they turned around and sold all those shares and made billions of dollars on U.S. taxpayer money. And somehow there was a bad rap for that, bailing out the financial or bailing out the big banks. But anytime the government has the opportunity to make money, and this was one right here, to stabilize markets and create a profit opportunity, they should take it. If I had any capacity to store oil, I would have took all I can, but I don't. I have zero capacity to take any oil. So when we have a huge demand shock in the system, or any shock in the system, first thing that happens is that big oil will cut back on production. That's what they will do first. And 2014, if we go back to 2014, that's when problems really started in the oil industry. So the price was above $110 a barrel. It encourages, when the price is high, it encourages a lot of production, and we brought a lot of oil to the markets. There was a supply glut, way too much oil, and the price eventually responded by falling. It fell 50 to 70% 2015, well below $50 a barrel. So big oil problems started 6 years ago, 7 years ago, and just may have culminated here, right when the price collapsed and went negative. This could have been, when we look back, and we might mark this as the bottom of the oil industry before it completely rebounds. So first thing that happens is supply cuts. OPEC just announced, OPEC earlier this month, OPEC will cut output to help stabilize or increase U.S. shale profits in 2021. So OPEC finally responded to a cut in production. So the second thing that will happen is the marginal players. The marginal players, the guys with the weak balance sheets, file for bankruptcy and maybe leave the industry altogether. So if we look at 2020 bankruptcies, the largest, Chesapeake Energy, was top of the list. They had almost $12 billion in debt, and that's what happens. These guys rack up a lot of debt on the balance sheet, and when the price collapses and revenues fall, they have no choice to file for bankruptcy to try to wipe out all this debt and return to the markets if they can. So third thing that's going to happen is, and this takes a little more time, is consolidation of the big guys. The big oil producers will go in and consolidate with some of the smaller guys. So that's what they do. They will consolidate into larger players. Chevron, for example, just bought Noble Industry last fall. They closed the deal last fall, and we're going to see a lot more consolidation in the oil industry. It has to happen. That's what happens when you have a shock like this to the industry, marginal players leave, they file for bankruptcy. Those that remain, there's consolidation phase that takes place where they will join or merge or get bought out. And same thing is going on in the restaurant industry. COVID have forced a lot of the mom and pop, smaller places, restaurants out of business. And some of these larger places, such as Texas Roadhouse, Chili's, Applebee's, and so on, that can survive a shock like this, will come back stronger. So restaurant industry also will provide an opportunity. Let's take a look at Chevron CFO and see what he has to say about the industry.
In our sector, trying to grow too fast with too weak of balance sheets. And by consolidating, we're going to end up with stronger financial players, with management teams that'll have more capital discipline, have lower G&A, and will be able to return cash to shareholders, which will be important for the sector. So, yeah, we feel like we led the way. In fact, we closed our transaction 2 weeks ago. Others are just announcing them now, but I think it's good for the industry.
Do you think there's going to be more deals?
I do. I can't speculate, but there's still a lot of players out there, and more consolidation makes sense to me.
Is this should our viewers and investors sort of read this as the growth is probably over? We should anticipate, these kinds of oil prices, 40 to 50, $35, whatever, for a long time. Is that how we look at it?
I wouldn't look at it that way. I mean, it's still a very difficult macro. I mean, we have recovered from the lows of the second quarter and stabilized, but we're still well below pre-pandemic levels. What I would view it, though, as this is an industry that is out of favor with investors. We hear that on your network often, in part because we have not earned appropriate returns on invested capital. We've not earned our cost of capital. And so the only way to earn above cost of capital is to be more disciplined with capital. Mike Wirth, our CEO, we think has led this way, and I think we're seeing others. And so I'd expect more focus on higher returns, less focus on growth, and that will be part of the equation of attracting investors back to the sector.
Chevron CFO, a couple points. He talks about more consolidation in the industry, which is going to lead to more shareholder value. And he also talks about Chevron and the whole oil industry has been out of favor on Wall Street. So that may be a sign right there. When such an industry is out of favor, it's time to step in and buy. And with the run up in some of the technology stocks over the last year and the COVID stocks, Zoom and others, they've been bid up to very, very high multiples. I'm looking for a sector that's out of favor, and oil may be it. So I don't want to buy into the sectors that have already been bid up. I'm looking to invest my dollars where I can find some value, and the oil industry may be it. Chevron CFO talks a lot about also returning value and really not focusing on growth. So he talks about cost of capital and earning enough that's greater than our cost of capital. If we look at return on equity is another way of saying that. Return on equity is a measure of how well the companies are reinvesting their earnings from operations. What are they doing with their dollars? Are they taking their dollars and making good investments with it? So if we look at return on equity, especially prior to 2015, return on equity for Chevron was well above 20% and even in the 30% range. So that all changed in 2015. I think we're seeing culmination in 2020 with the COVID crisis, and the whole market's going to consolidate and supply cuts, and they're going to bring a lot more value to shareholders. And so let's take a look at a couple of the big names in the oil industry. Of course, there's Chevron itself and ExxonMobil. I'm just going to highlight 4 ways to play the oil industry. One is Chevron. Chevron is probably the biggest company out there, and they also have the cleanest balance sheet. So I like to look at their dividend yield. I'm attracted to dividend. The higher dividend yield I can get, the happier I am. So if we look at dividend yield over time, so prior to COVID, dividend yield was 4% or less, and now it's trading at 5.8% right now. So the dividend yield is 5.8. You get $5.16 every year for every share you own. So when I look at dividend yield over time, if the stock has a current dividend yield that is higher than the past history, it's generally trading at good value. So I like Chevron. ExxonMobil is the other big player. Of course, they have a higher dividend. They have 7.2%. If we look at their dividend yield over time, prior to COVID, it was trading at 5% or less. Today it's at 7.2%, meaning you get $3.48 every year for every share you own. So ExxonMobil, only problem with ExxonMobil is they just have a lot more debt on their balance sheet. Another way to play it is EPD, Enterprise Products Partners. So they are a transportation company. They transport through 4 segments. They have oil and gas transportation pipelines across the U.S., and they deliver oil and gas to the end user. So their dividend yield is 8.66%. Again, that is higher than it has been historically. So for every share you have, you get $1.80 in dividends per year. I've invested in EPD. I bought under 20, and I plan on holding onto it for a long time. Another way to play it is through the energy sector Spider Fund, XLE. So this is an exchange traded fund. They own several different companies. ExxonMobil, Chevron, they have 24.04%. ExxonMobil, 21.64%. Chevron, they own a bunch of other companies. So if you're looking for a diversified basket, the XLE might be the way to go too. So you're going to get some value in there. And of course, their dividend is trading over 5% too. So it's definitely a dividend play. If you're into dividends and you want cash now, dividends may be the way for you to go. But there's other ways to play the oil industry. There's just 4 I highlighted. Of course, oil is going to be a long-term play. I don't think you're going to gain a whole lot on growth in the short term. We're just starting to see a lot of consolidation, supply cuts, and so on to help bring the industry back up to returning shareholder value. So that is oil. That's all I got for oil. If you like what you saw, just hit the subscribe button, and we'll talk later.